The Asia-Pacific automotive parts market, it's projected to hit almost $80 billion in the next few years.
Wow, that's a huge number. Really makes you think about the companies in a position to, benefit from that kind of growth, right?
Yeah, for sure. And that's what we're diving into today.
All right, let's hear it.
We're looking at SAG Holdings Limited, SAG for short.
Okay, SAG Holdings Limited.
They distribute automotive and industrial spare parts. Been around for like 4 decades.
4 decades, that's impressive. So they must know what they're doing.
Right. Based in Singapore, mostly operate in Malaysia and the Middle East.
Interesting. So a real player in that region.
Yeah, exactly. And we're going deep, giving you the quick download on SAG Holdings and this whole industry. We've combed through stock analysis reports, financial data, company info, the whole 9 yards.
All the good stuff so people can really understand what's going on.
Yep. All the resources are linked in the description if you want to go even deeper. But today, our mission, you could say, is to see if SAG Holdings is a good bet for a long-term investment. We're using that value investing lens.
I like it, a long-term perspective.
So we'll be looking at their business, the management team, how their finances look, what's happening in the market, who owns the company, and any risks on the horizon.
Really breaking it all down. That's what people need.
Okay, let's kick things off by understanding what SAG actually does.
Let's do it. What's their core business?
Basically, they distribute high-quality spare parts.
Spare parts. Okay, that's broad. What kind?
Both on-highway, think cars, trucks, that sort of thing, and off-highway, which is more like industrial equipment.
Ah, so they've got their hands in 2 different pies. I see the strategy there.
Exactly. Could be a real advantage, like a natural hedge, right?
Right. One market dips, the other might hold steady. Smart.
Now, in the on-highway segment, they offer both OEM parts, straight from the original manufacturer,
Right.
and aftermarket options. They even have their own brands, like SP Zone.
Oh, so they're not just a middleman, they're building their own brands too.
Exactly. And on the off-highway side, they focus on parts for internal combustion engines used in all sorts of industries.
Like what? Give me some examples.
Marine, energy, mining, agriculture, construction, you name it. But their big focus there is their Filtech brand for filtration products.
Filtech. Okay, so they're going deep in that specific niche.
Yeah, becoming the go-to for those specialized parts. And their product catalog is pretty extensive. They've got OEM parts, third-party brands, and then a whole bunch of their own in-house brands.
Wow, a whole bunch, huh? What kind of brands are we talking about?
Well, there's NewTek for steering and suspension, Gentech for pumps and cooling, Elito, cables and hoses, Sunblade for wipers, Filtech for filters, Energio for batteries.
So they're really covering all their bases.
Yeah, aiming to be a one-stop shop for spare parts. Now, as for their footprint, they've been based in Singapore for 40 years.
I know, you said 4 decades.
Right. But they've expanded to the Middle East and Malaysia, and they even have retail stores called AutoZone in both Singapore and Malaysia.
Retail stores, interesting. Mainly for the on-highway stuff, I guess.
Yeah, mostly. And their market capitalization, it's kind of small. Different sources show anywhere from $6 million to $19 million.
Small cap. That can be, a bit volatile, but also potentially undervalued.
Yeah, could be. But it does make you wonder about the accuracy of some of this data, right?
Yeah, for sure. When a company's under the radar like that, got to double check those numbers.
So what is SAG really offering to its customers? It boils down to this: high-quality spare parts that keep things running smoothly and reliably.
Minimize downtime. That's key for any business relying on those machines or vehicles.
Exactly. They also help their partners expand their reach, and they're all about service, reliability, and offering both those genuine OEM parts and more affordable aftermarket options.
So they're playing both sides of the field, giving customers choices.
Yeah, I think that's a good way to put it. So to recap, SAG Holdings, they get those automotive and industrial spare parts, and they get them out to their customers in Singapore, Malaysia, and the Middle East.
Okay, makes sense. So who's running the show? Who's making all this happen?
All right, let's talk management. At the top, we have Mr. Chin Heng Neo, goes by Jimmy Neo, the CEO.
Jimmy Neo, all right.
He's got over 25 years of experience, specifically in that off-highway sector.
Oh, so a real veteran in that space.
Yeah. And he's credited with setting up their SP Zone operations and sales channels.
So he knows how to get things done.
Then there's Mr. Chin Heng Neo, Edward Neo, the deputy CEO.
Got it.
He brings over 30 years of experience, but on highway side.
So they've got both sides covered with experienced leadership.
Exactly. Deep knowledge of both sides of their business. And here's an interesting tidbit. The CEO's total compensation is about $152,450.
Okay, that's not exactly chump change, but
It's actually less than what CEOs at similar U.S. companies make.
oh, so maybe they're not just in it for the big bucks.
Maybe not. He's been in the role for about 3 years now. They also have a whole investor relations section on their website with announcements, filings, contact info, the whole shebang.
Transparency's always a good sign. Shows they're thinking about their investors.
And they've got a code of ethics emphasizing, honesty, fairness, respect, integrity, sound judgment. They monitor conflicts of interest, have a whistleblower policy, the works.
Okay, so they're taking ethics seriously. That's not always a given, especially in the corporate world.
Right. So based on this, does the management team seem, well, honest, capable, shareholder-focused? What do you think?
I mean, on the surface, it looks promising. They've got the experience, a commitment to ethical practices, and that compensation thing, it could indicate they're more focused on company performance than just lining their own pockets.
That's a good point. Now let's dig into their financials. Time to see if those numbers back up the story.
Yeah, let's crack open the books.
So first up, market capitalization. We already touched on this.
Right, the 6 million to 19 million range.
Exactly. And that kind of inconsistency, it's a little concerning.
Yeah, you always want to verify this stuff with their official filings, especially with smaller companies like this.
Absolutely. Then there's the price to earnings ratio, the PE ratio.
Right, that tells us how the market values the company relative to its earnings.
And we see a range here too, about 2.9 to 4.3. Some sources even say it's not applicable or 0.
Huh, that's strange. Makes you wonder what's going on there.
Yeah, really highlights the need to go back to those primary sources.
Really?
Now, revenue growth. For the 12 months ending June 2024, they saw a 4.5% year-over-year increase.
Okay, so some growth there, not bad.
And in 2023, their annual revenue jumped by 15.7% to $59.52 million.
Wow, that's a pretty significant jump.
But there's a but. The 6 months ending June 2024, revenue actually decreased by about 10.1%.
Oh, so a recent downturn. That's something to keep an eye on.
Definitely something to investigate further.
Yeah.
Now, the profit margins, gross margin sitting at around 19.68%, operating margin about 4.73%, and net margins somewhere between 3.33% and 3.7%.
Those are pretty thin margins, aren't they?
Yeah, not huge. Could be due to competition or higher operating costs.
Right. You need to see if they have any advantages that can help them improve those margins over time.
Now, the debt-to-equity ratio, this is where it gets really weird. Some sources say it's as high as 6.3 rate.
6.30, oh, that's pretty high.
Others say it's 0.
0, that makes no sense.
I know, right? Major red flag.
Yeah.
Got to check those official balance sheets.
Absolutely. You can't trust those aggregated sources when they're this far apart.
Okay, on a more positive note, they generated $1.29 million in free cash flow. And their price-to-book ratio is between 2.01 and 2.4.
Okay, so they're generating cash, and the price to book is relatively low.
Yeah. So, bottom line, are they profitable? Do they have a strong balance sheet?
Well, they are profitable based on their net income, but that balance sheet with those conflicting debt numbers, it's hard to say for sure.
Right. Definitely some uncertainty there. Plus, they have about $14.97 million in net debt.
Okay, so they do have some debt. How's their interest coverage?
Their interest coverage ratio is reported to be between 2.51 and 2.97.
So they can cover their interest payments for now, but that debt level is something to watch closely, especially considering the market cap.
All right, let's look at their financial stability over time. Over the past 5 years, their net income has generally been trending upwards, going from $297 million in 2020 to $1.88 million for the 12 months ending June 2024.
Okay, so a consistent upward trend in earnings, that's a good sign.
But the growth rate has been kind of bumpy.
Yeah.
And they don't currently pay any dividends.
No dividends. That's not uncommon for smaller companies. They might be reinvesting those profits back into the business.
And as we discussed, there's that uncertainty around their debt-to-equity ratio. But we know their net debt is about $14.97 million.
Right, and they seem to be managing the interest payments for now.
Finally, their working capital. Current ratio is 1.04, quick ratio is 0.55, working capital is $1.57 million, inventory turnover is 2.57.
Okay, so they're a little tight on liquidity if you don't count their inventory.
Yeah, the quick ratio being below 1 is something to note.
And they're selling their inventory about 2.5 times per year. Gives us a sense of how efficiently they're managing that.
So to wrap up this financial deep dive, SAG is profitable, but there are question marks around their balance sheet, specifically their debt, and that recent revenue dip is, A bit of a yellow flag.
Agreed. Lots to consider there.
All right, that brings us to the end of the first half of our deep dive into SAG.
We covered a lot of ground there.
Yeah, we looked at their business, the management team, and their financials. Up next, we'll dive into market sentiment, ownership structure, and assess the risks and opportunities for SAG Holdings.
Sounds good. Looking forward to it.
Welcome back to the second half of our deep dive into SAG Holdings.
All right, let's get back into it.
We left off talking about their financials, but now let's see how the market feels about SAG.
Market sentiment, yeah, that can be a fickle beast.
For sure. Well, their stock price has been on a bit of a roller coaster ride this past year. It's traded as low as $0.47 and as high as $8.27.
Wow, that's a wide range. Very volatile.
Yeah, and right now it's trading quite a bit lower than that 52-week high. Might be a sign that investors are cooling on them a bit.
Could be. What do the analysts say? Any price targets out there?
Interestingly, none of the sources we looked at had any analyst price targets for SAG.
That's a bit unusual. But hey, sometimes those under-the-radar companies can be hidden gems.
That's true. No analyst coverage could be a good thing for value investors.
Exactly.
Now remember, SAG had its IPO in October 2024. Shares started at $8.
Right, just a few months ago.
And their Philtech subsidiary, they implemented automation in their distribution center back in November 2024.
Oh, so they're making some moves to improve operations.
Yeah, but it's interesting, right? The stock is currently trading much lower than that IPO price.
Yeah, that is interesting. Could be a sign that the initial valuation was too optimistic.
Or maybe something else is spooking investors.
Could be market conditions, company-specific news.
Hard to say for sure.
Definitely worth investigating further.
Okay, let's talk about short interest. It's pretty low, around 0.04 million shares, which is about 1.12% of the float.
So not a lot of people are betting against them right now.
But here's the thing. The cost to borrow those shares for short selling, it's crazy high.
Crazy high. How high are we talking?
Like 55% to 65%.
Wow, that's really high.
Yeah, it is. Makes you wonder what's going on there. Maybe there's just not a lot of shares available to borrow.
Could be. Or maybe there's some perceived risk associated with shorting the stock despite the low short interest.
Interesting. We didn't find much info on options trading for SAG either.
Okay, so not a lot of activity on that front. All right, let's shift gears and talk ownership structure. Who owns SAG Holdings?
So institutional ownership is very low, about 0.19%. The top holders are UBS Group AG, Tower Research Capital LLC, and Bank of America Corp. But their stakes are pretty small.
Yeah, not a lot of big institutions in the mix. That's not unusual for a smaller company.
Now, insider ownership, that's a different story. It's substantial, anywhere from 60% to over 80% depending on the source.
Wow, so the people running the company have a lot of skin in the game.
Exactly. Soon, SAG Global Pete, Ltd., holds a majority stake, about 60.07%. And we didn't see any reports of recent insider buying or selling.
Interesting. Could mean they're content with the current valuation, or maybe they're just waiting for the right moment to make a move.
Yeah, who knows? But that high insider ownership, it's generally seen as a good thing by value investors.
Right, it aligns their interests with those of other shareholders. They're not just going to run off with the money.
Exactly. So we have a highly concentrated ownership structure, with soon SAG Global Pete Ltd. As the controlling shareholder. The top 5 shareholders together own about 60.26% of the company.
So even after the IPO, SAG will still be considered a controlled company under NASDAQ rules.
That's right. Now, in terms of corporate governance, SAG has a code of ethics, an insider trading policy, and charters for their audit, compensation, and nomination committees.
Okay, so they've got some structures in place for accountability and oversight. That's a good sign.
All right, let's move on to our risk assessment. We'll use a SWOT analysis to break down SAG's strengths, weaknesses, opportunities, and threats.
SWOT analysis, classic. Give us a good overview of where they stand.
Starting with their strengths, they've got that 40-year operating history in Singapore, an established distribution network across Malaysia and the Middle East.
Yeah, those are big pluses. Shows they can navigate those markets and have built relationships.
They've also got a diversified portfolio of spare parts, including those in-house brands like Philtech, and of course that high insider ownership we talked about.
So they're not just relying on one product or market, and the management team is heavily invested in the company's success.
Now, on the flip side, their weaknesses. We had that small market capitalization, the inconsistencies we saw in their reported financial data.
Yeah, those were concerning.
The recent revenue decline in the first half of 2024, potentially high debt levels, no dividends, and very little institutional ownership.
So some red flags to be aware of, especially that data inconsistency and the declining revenue.
All right, let's talk opportunities. The Asia-Pacific market for auto and industrial spare parts, it's expected to grow significantly. SAG could expand their geographic reach even further, tap into that growing demand for quality parts.
So they're in the right place at the right time, potentially, and they can leverage those in-house brands to really capitalize on that growth.
Right, and there might be opportunities for consolidation within the industry. SAG could acquire smaller competitors, become a bigger player.
Interesting. Could be a smart move if they can find the right targets.
Now, of course, there are also threats. We have the highly competitive nature of the spare parts industry.
Yeah, lots of players vying for market share.
Economic downturns could impact demand for both automotive and industrial parts. Raw material prices might fluctuate, messing with their costs.
Right, those external factors can be hard to predict.
Supply chain disruptions are always a possibility these days, and then there's the risk of counterfeit parts.
Yeah, counterfeit parts. That's a big problem in this industry. Can really damage a company's reputation.
And we can't forget about the elephant in the room, the long-term shift towards electric vehicles.
Right, that's the big one. Could be a major disruption to the traditional spare parts market.
So, to quickly summarize, SAG operates in a growing market. They've been around for a while, experienced management with a lot of skin in the game, but there are those concerns about their financial data, the recent revenue dip, potential debt, and how the market's reacting post-IPO.
Yeah, it's a bit of a mixed bag. Definitely some potential, but also some risks to consider.
And that brings us to a question for you, the listener. With electric vehicles becoming more popular, how does a company like SAG adapt? Their business is based on parts for internal combustion engines. What happens when those engines become less common?
Right, it's the big question. They need to think about the future. What new types of parts or services will be in demand?
What if, as cars change, SAG's strength becomes their distribution network and logistics? Maybe they become essential for a whole new generation of vehicle maintenance, no matter what powers the car.
That's a great point. It's not just about the what they distribute, it's about the how. Their expertise in getting parts to the right place at the right time could be incredibly valuable.
So much to think about. Well, that wraps up our deep dive into SAG Holdings. We hope you found this analysis helpful, gave you good understanding of the company and what to look for as a potential investor.
We tried to cover all the bases, give you the info you need to make your own informed decisions.
And if you enjoyed this, hit that subscribe button for more in-depth analyses like this.
We're always digging into different companies and industries, breaking down the complexity so you don't have to.
And now for our standard disclaimer. This analysis is for informational purposes only, not financial advice.
We're just sharing our research and thoughts, not telling you what to do with your money.
And those stock discussions in the comments, they're just for fun, for discussion, not recommendations.
Do your own research, people. It's your money, your responsibility.
Couldn't have said it better myself.
Always good to be reminded of that.
One final thought before we go. The companies that thrive in the future, they won't just be focused on what they sell today.
It's about adaptability, being able to change with the times.
Exactly. For SAG, it's about how they adapt their distribution capabilities to meet the changing needs of transportation and industry. Thanks for joining us on the Deep Dive.
Thanks for listening, everyone. Until next time.